Oh, it's view red. Very good to go.
Okay, so welcome everyone to our special session on cryptocurrency. It's a session sponsored by Mercado Bitcoin. So we have the pleasure of having with us Professor Carol Alexander and Professor Alberto Rossi. They will be discussing about some aspects of cryptocurrency, not related directly to technology, but how investors and the flow of information goes through each market. So it's a great opportunity to hear both of them talking about this issue. And before we start, I will give a brief instruction. If you have questions, please use the chat box or the Q&A box, and we can follow on with your questions. Feel free to ask anytime. We will be collecting your questions, and even the panelists will be able to handle your questions. So before I pass the word to our speaker, I'd like to introduce, even though she's very well known, but I will introduce Professor Carol Alexander and then Professor Alberto Rossi. So Professor Carol Alexander is Professor of Finance at Sussex University Business School. She's also visiting professor at Peking University, HSBC Business School, and the co-editor of Journal Banking and Finance. Her current research focuses on practical and regulatory issues with cryptocurrency derivatives markets, such as information flow to and from unregulated exchanges. She's author of a book with Douglas Cumming from Florida University, the book called Corruption and Fraud in Financial Markets, Malpractice, Misconduct, and Manipulation. And she is also the author of the best-selling book in 4 volumes, Market Risks. And so thank you very much, Professor Carol, to be with us. And the floor is yours.
Thank you very much, Alan and Rui, for inviting me. So today I'm going to be talking about Binance and Tether. They've been very much in the news recently. So if I share my screen, first of all, let's do that. I always forget to do that and I start talking without my slides. But here we are, there's the slides. So let's see how this works. Okie dokie, I've got the chat box open here in case anybody wants to ask questions. It would be nice. I'm not going to take very long because the nice thing would be to have a lively discussion and questions. So there's only 18 slides. Okay, just some background. Let's have a look at the last year. I'm only going to be focusing on the last year of data because crypto markets really took off following July 2020 when US banks were allowed to be custodians of Bitcoin, and that really drove the business towards institutions, and volumes increased enormously. And we experienced, as you can see with the green line here, another asset price bubble in Bitcoin where it was been around 10,000 for more than a year, and then in November it started to take off and reach over 60,000, that's dollars on the left, and now it's trading just above $30,000 per Bitcoin. And the red line shows the market cap of Tether, which was only just above, it's on the right-hand scale, 10 billion. They certainly didn't have enough collateral to cover 10 billion at that time, nor do they have sufficient collateral to cover about 62 billion at the moment. They stopped printing Tether in June. That's because Binance, is the main exchange, as we shall see, is not requesting any more Tether. In fact, there's more Tether outflows than inflows. One has to do quite a lot of forensic analysis on this because Binance are not straightforward about the data that they provide, least of all to their customers. Anyway, so you can see how the growth in Bitcoin and other crypto is linked to the printing of Tether, which is a stable coin that's supposed to be linked 1-for-1 with dollar. Now, more about Binance. Binance sells itself as the best hedging venue for traders. It has the lowest fees. It has a very strong matching engine, which is very quick to, this is for derivatives trading, of course. They do have spot trading, but the main, these unregulated exchanges that have grown up all over the world, we don't know where they're domiciled. Some of them, like Huobi and OKEx, we know they're in Singapore at the moment, and I think Deribit, it's an option exchange, is in Panama. The last time Binance registered any domicility was Malta, but then the Maltese authority said that there's no record of any of the Binance or Binance subsidiaries, of which there are around at least 25 registered in Malta. And you will have heard in the news about many jurisdictions refusing licenses for the subsidiaries that Binance tries to roll out to retail investors rather than these large hedgers. A market maker in crypto has to have accounts on many different exchanges, although there are products such as Bullish, which has just sold for many billions of dollars to a special purpose acquisition vehicle, that collate all the venues and with just one API. Otherwise, most sophisticated market makers have to have APIs, application processing interfaces, to all these maybe 23 different exchanges. And although the exchanges don't close, so there's not the usual need for a market maker to hedge overnight risk with futures, they do need to hedge the imbalance in their books on different exchanges. And most of them do that using Binance. But Binance is a crypto-only exchange. You need Tether or Bitcoin or some other crypto to what we call onboard to the exchange. And at the moment, there's a class action going on. If any of the people watching this were affected, not just by the events of 19th of May, but perhaps 18th of April, or previously, there's some class actions going back in Russia many years. There is a lawyer, a legal firm called Lexia, who are trying to coordinate a cross-border class action between Australia, France, Switzerland, Italy, any other countries, so Russia, Ukraine, and so forth. Do get in touch with Lexia if you're affected. Now we can have a look at the Binance Perpetual. This is the main contract. So if I just look at the, you can see the forces of Sauron are up against each other. There's quite a lot of spoofing and manipulation. Of course, there's no market regulation whatsoever. It's a bit difficult to see this. I might be able to zoom in here on the 24-hour volume on this product alone is 16 billion. That's in Tether. There are various things here like the funding rate I'll explain. But as you can see, this is a major product. This particular product is something that the sophisticated market makers ignore. They prefer to use something called an indirect futures. In fact, futures and perpetuals are completely unique to crypto markets. So we'll talk about those products a little bit more in a minute. Now, oops. Oh, my screenshot had something. I'll have to change that in the next slides. But so the blue line measured on the left is the Binance daily trading volume overall. It reached 100 billion, most of it on that Tether Perpetual on the 19th of May. But it was hovering at the height of the bull market in Bitcoin around the 50 to 75 billion dollars per day traded on Binance. And has since declined dramatically. It's almost down to the levels of 10 billion a day or so. And as I said, most of it is on the Bitcoin Tether direct perpetual. The red line shows the daily change in Tether market cap. And you'll notice from this that it became extremely volatile this year, just as the volume on Binance was increasing. Now, the issuance of Tether you saw in that very smooth first graph that looked like a sigmoid curve because it's beginning to tail off now, if it was the price of Tether was actually pegged 1-for-1 with the dollar, we wouldn't see this variation in the market cap. And if I use the block data or any other more reliable source of data, I do get reliable prices for Tether that show really extreme price swings this year, up 5% above or below. But if you go onto Yahoo or anywhere else, the feeds that they're given from Binance show a very stable coin. But in this market cap graph, you can see the instability in the price is the main reason. And there's also a decline there, so it's below zero most of the time. And Binance own at least a third of the market cap of Tether. This is a rich list that is just compiled from the hot wallets. This is a Tron wallet, but they have other wallets as well. There's a cold wallet there that's got a small amount. I don't know where they managed to get a cold wallet address. But anyway, if you add all up the others, this accounts for about 40 billion Tether in either Ethereum or Tron wallets. I'm not sure where the rest of it is, but there we are. It's a major holder of Tether. Now, I'm going to focus on these perpetual contracts because they're the most interesting and unique to crypto markets. So they're like futures, and they're also a little bit like a currency swap because, of course, it's for one currency against another. So some people call them perpetual swaps, some call them perpetual futures, but they are perpetual. In other words, there's no expiry date. So if it were a currency swap you're modeling it on, there would be no exchange of principal at some point in the future. And what ties the perpetual price to the spot price is something called a funding rate payment. And these are regular payments that if the perpetual price is above the spot price, the long holder pays the short holder a very small percent. Usually there's a base rate, which is a sort of interest rate, which is positive. And usually the funding payment is from long to short, although you can see in this bear market that we've had for the last couple of months, most of the funding payments have been from short to long. Nevertheless, they're not that big, but they're big enough to affect the market makers that have pretty large positions on Binance. And so we'll see how the market makers avoid them in a minute. You can find out more on these links to the funding rates and how they're calculated. So I'm just going to look at the Binance and the Bybit. There are many others, OKEx, Huobi, Deribit has a perpetual for the options traders to delta hedge with, and so forth. But I'm just going to compare these two for now. Later on, I'll look at Huobi, maybe OKEx. Yes, I think, but I'm not going to show you OKEx results. They're very similar to Huobi. So the inverse perpetuals are the ones that actually have the margining and settlement in Bitcoin. Even if you look on the price, it looks like it's the dollar price of Bitcoin. It's actually the other way around. The direct contracts, oh, this is a mistake. Another typo to correct. This is direct, okay? The Tether contracts are direct. I've got these slides up on my website and I'll show you where to get them, but don't download them until I only just finished them just now. So the Bybit contract is 1 Bitcoin. It's a bit like contract for gold, right? The Binance Tether contract is much smaller. And the margin rate from Bybit is standard, only 1%, whatever the size of your position. With Binance, the margin rates, they will increase with the notional value. So if you have a very, very large position, you'd have to have 100% or 50% initial margin. They all trade 24/7, and the funding rates frequency, the payments are made every 8 hours. So when we go back to the web, I'll show you what time the next funding rate payment is. It's at 0, 12, and 8 UTC. No, 0, So what am I talking about? Zero, every 8 hours, 0, 0, then 8, then 16 UTC. Bybit encourages wash trading with this. The maker fee is negative. In other words, if you have 2 accounts and trade against yourself, then you earn Bybit coins, but the taker fees are much larger, and Binance has this basis point fees very, very small, as they claim. Okay, so those are the perpetual contract specifications. But the margin mechanisms is where the really interesting thing happens, because Binance and these other exchanges act as their own central counterparty for clearing. There are no margin calls. In fact, there's these 3 things: auto liquidations, insurance fund payments, and auto deleveraging, which are really interesting to study. And not a lot of people understand that, least of all the people that were caught in the outage of the entire futures order book for about an hour on May the 19th. And many of them were unable to exit positions and lost sums, you know, the small individuals, but, you know, some of them lost $250,000 or more. So suppose I'm Alice and I want to open a position of $250,000 tether on the direct perpetual. On the tether perpetual, and with that size of position, I can have 100 times leverage. For a bit smaller, I can have 125 leverage, but say I can have 100 times leverage. In other words, my margin rate is 1/100 or 1%, which means I only have to put up 2,500 tether to test on that size of position. Now, maintenance margin rates are always half the initial margin rate. So in this case, the maintenance margin rate is 0.5%, 50 basis points. So at the level of 1,250, I would need, that's the maintenance margin level. If I lose enough for my margin account to go below that, then I actually will get completely wiped out. There is no margin call. On a normal exchange, I will be warned when the collateral in my margin account gets very low, and I would be given time to top it up. And then if I didn't, at least the default process would take time. Here it's all instant, happens immediately. So if I get to a point with just, if it's a 5% maintenance margin, then a Bitcoin price fall of 0.5% is enough for my collateral to be wiped out. If I had a maintenance margin of 3%, then a Bitcoin price fall of 3% is enough for my collateral to be. So you know how much you have to watch these movements very carefully, and you have to top up your own margin. You won't get a call. And if you don't, in particular, if the exchange goes out, you can't. If your marked loss exceeds the collateral in your margin account, then that's it. And in fact, some of it is paid to your counterparty. A small fraction of it goes into something called the insurance fund. So what's the insurance fund for? Well, my loss is my counterparty's gain. So say Bob was short exactly the same position as me. When I was auto-liquidated, he should have got the 1,250. And that's fine if it's a small amount, but suppose the price of Bitcoin falls a large amount in a very short time. And it can quite easily fall 10% in the space of minutes or hours. It's such a volatile product. So if it falls 10%, then actually I should owe Bob 10% of the stake, which is 25,000 tether. But I only put on 2,500 tether, so where's that going to come from Bob? It's coming from the insurance fund, all right? If they've got the money. So it should come from the insurance fund, but first of all on April 18th, and then again on May 19th, there were so many auto liquidations of very, very large gains on the other side that the insurance fund, I'm sure, was not adequate to deal with it. So what happens then? Well, Bob thought that he, like me, had 100 times leverage. He put up a margin of 2,500 for a 250,000 position, but suddenly he thinks he's actually made a gain of 25,000 and no, he hasn't, because he's been automatically deleveraged. And his gain is suddenly not 25,000, but maybe he's only got a 10-time leverage, so his gain is only 2,500. Many people don't understand this mechanism, so I thought I'd go through it with an example to explain. Now, the time patterns of auto liquidations as a percentage of open interest, and this is using data over this year from coinanalyze.net. Now, exchanges are supposed to report liquidations every 4 hours accurately. I'm sure that Binance no longer does that, but even if they did, you could see that the long liquidations in blue and the short liquidations in red are much, much larger as a percentage of the open interest than they are on Bybit. And they tend to happen around the weekend, Sunday, 0, this is UTC time, or Monday before the US markets open. Okay, now I'm going to quickly move on, and I'm not going to go through the maths on this slide. If you're interested, you can look at the maths, you can look at the paper. All right, it's just a vector error correction model, which is a standard, fairly easy econometric model by which you can compute the component share and something also called the information share of Hasbrook, or a modified information share. And these answer slightly different questions. The information share says when new information enters the network, what proportion of the total price innovation originates on Binance, and what originates on Coinbase or Kraken or Bitstamp or Binance. Is on the direct perpetual, what's on the spot, what's on the indirect perpetual. Assigned shares of this sort of common long-term efficient price. This thing here actually turns out to be a common efficient price, and then there are deviations which used to be bigger, but now they've all been arbitraged away. So this is the log price at some time t, it's where it started. The common price, this is the same for all of them, and then any arbitrage that you can make. So the way we do this, and this is a paper that I haven't finished yet, but it's with an MSc and a PhD student at the University of Sussex. It will be called The Role of Binance in Bitcoin Price Discovery, and it follows on from a sequence of papers that I've written about BitMEX, but BitMEX is now no longer the main exchange. We use minute level data, we estimate these things, we do the component shares and the information shares, and then we do it day by day, so re-estimate every day from August last year until just now. And what we see is that if we look at Bybit compared to Coinbase, Coinbase is much more dominant in the price discovery role than Bybit, or indeed Kraken, which is the dark blue here, or Bitstamp, which is the mid blue. Okay, so those are the two Bybit inverse and direct products. But when we look at Binance, even if we just look at the two products, even more when we look at the Binance spot, Coinbase is no longer the dominant source of price discovery. The traders on Binance are driving Bitcoin prices, and we already saw how much manipulation can go on with spoofing just looking at that order book, okay? So this is a concern to regulators. The other thing, and this paper is available, it's on the archive, but again, I would delay a little bit because in a week or so I'll have a much better version up there. But if you want to have a look at that or on SSRN, do wait a bit. So this is with Daniel Heck, the same PhD student, and Andreas Cake, who's a professor at Sussex. And we're looking at some fairly sophisticated models that look at volatility spillovers in very high frequency data. So this is even higher frequency, the minute level, it's tick level data. And we look at how the flows of volatility between these spot and perpetuals. We're not bothering to look at futures, standard futures exist, but the volume's so much lower. Everything is on the perpetuals, that's where the action is. We ask how they change during the course of the day, where Bitcoin volatility emerges and which exchanges it transmits to. So if we just look at realized volatility, okay, this is 5-minute realized volatility. There's a bit of filtering going on just to make sure that it's properly done, pre-averaging, Windsorizing and so forth. But you can see the Kraken realized volatility is lower apart from these peaks here. There's more volume on Coinbase, so one would expect larger volumes, and also on Bitstamp. All three exchanges jump up at 12 UTC, and this is when the US markets open, but we've also got these peaks that happen, particularly, there's one, I'm not quite sure what that Kraken peak is there, we'll have to take a closer look at that, that's an idiosyncratic one, but they all peak here, which is the time of a funding rate payment, and here, and here. So clearly there is activity of volatility being transferred around the times of the funding rate payments, but we dummy those out in this very sophisticated model. This is a very simple version of it, actually. We've got asymmetric terms and, as I said, dummy variables to pick up times of day and so forth. And just to give you, you should read the entire paper because the volatility transmission is really obvious during US opening times, not so much during Europe or Asia at all. It's really all coming from the US, and we show that with this model. We do various sub-models, but this is just looking at the main instruments from the spot, which is Coinbase, clearly is the volatility transmitter and volume transmitter in the spot. And then we look at the Binance and Huobi spots as well. And then we look at the Binance and Bybit and Binance, the Bybit Tether, Binance Tether, and Binance USD. And what we find is a nice way to represent these results. So the red is the Binance Tether Perpetual, the blue is Coinbase, the black is the Binance Inverse Perpetual. That's not transmitting very much volatility. It's just a little black line goes from Bybit, from Binance to Bybit on that. Coinbase is transmitting very little. You can see a bit of Coinbase spilling over into the Binance, into Bybit, into the Perpetual there, Huobi. But the main thing is the red, isn't it? It's everywhere. It spills into every other exchange, and the Binance Spot also spills into the other exchanges. So there we are. That's a very rapid overview of the sort of things I'd be happy to discuss. I have no idea what the time is, but there we are. Shall I just ask that and maybe stop sharing my screen? I can share again. Should I stop sharing my screen to answer questions, or?
No, you don't need to share your screen, Carol, unless someone asks you a particular question and you want to answer using your screen. But feel free to screen your to share your screen if you will. Well, we have also here Jefferson with us. Jefferson will be helping me to handling the questions you might have. I think Jefferson also has a question, but before we open for the general Q&A session, and before I also pass the word to Alberto, Carol, if I correctly understood, we have the flow of information and the volatility coming from the perpetual futures to the spot one, right?
To Coinbase in particular, and Coinbase also spills over to the other spots, yes.
Right. So that seems to me like the tail wagging the dog, right? Because in general, what we have, the spot determining the future price. That's what we usually have for traditional future contracts. So we have a good market for the spot, and then we do have the future or the forward based on the spot one. And here what we see is the opposite, right?
No, it's the same. It's the same. You know, when you've got something like Spider and the S&P futures and S&P spot, it's usually the futures, then the ETF, then the spot. And here we don't have ETFs, thank goodness, yet. Good old Gary Gensler's kicking them into the long grass as much as he can. And that's going to be a big can of worms if that happens. But the perpetuals, they're called perpetual futures. So, you know, they operate like futures.
Okay.
I'm not using the standard futures because the volume is really not there to warrant it.
Okay. All right. Any other questions we have so far?
Yes, there's Jefferson.
Keith, thank you very much for inviting me. It's a pleasure to be here. I liked a lot the presentation of Professor Carroll. I have one question, actually, because when we see this large fluctuation in Bitcoin prices coming from regulated exchanges, such as Binance, and also thinking of Griffin and Shams, the GF paper in 2020, that have empirical evidence that Tether is used artificially to pump prices of cryptocurrencies, and potentially this nowadays $62 billion in Tether, they're not fully backed. So I'm thinking of like the systemic risks, thinking of a participant of the crypto market. How do you see like these two and other forces acting like we are? Do we know the true risks we are facing?
We don't. Well, I mean, we do, some of us do, but not many. And I think regulators are really always behind the curve, and trying to regulate these exchanges like Binance is a nightmare, because whose responsibility is it, and where are they? I mean, are they just going to hang around in Hong Kong and hope CZ comes out of some office somewhere? Maybe they can shut down the servers. But anyway, okay, it's a very sensible question. It's something that I've given some thought to. So Tether is supposedly mainly collateralized by commercial paper, US commercial paper, although that's contentious. So I don't know how much you know about the history of this, but the New York State Attorney was trying to get some sort of audit evidence from Deltec Bank in the Bahamas. And as with everything, there's no name or even institution on any correspondence, though, you know. So what they did achieve, tiny stupid fine, but a quarterly audit. And their first audit in May, I think the best source to look at what they have is Fitch. I wonder if I can show you what Fitch say about the Tether collateralization. Yes, no, that's FT, sorry, wait a minute. Okay, this is the Fitch one, I think. Yes, so I'll share my screen and you'll see the Tether reserves breakdown here. Okay, so this was on the 31st of March. You see if I can zoom in on this a bit. Oops, there we are. All right. 50% commercial paper, 10% corporate bonds, funds and precious metals, 18% fiduciary deposits. I suppose they mean some sort of cash there. And then they've got secured loans, treasury bills, you know, real, you know, things that are liquid. Commercial paper is, you know, it's loans to companies. So apparently their collateralization is, yeah, no, I lent $1 billion to Uncle Bob. Did you really? Where's the evidence? Because nobody actually knows where it is. So suppose that people are sensible and start trying to cash out of Tether, okay? And it happens all at once. And it's going to, because did you see what happened to USD coin? Since Tether stopped printing USD coin, which is perfectly collateralized and audited. That's a Circle Group product, and it's being audited every month by Grant Thornton. So why use Tether when you can use USD coin? Yeah. So it will happen pretty soon, I think. And then the question is whether this suppose that they actually have got bona fide counterparties. They're going to call in all those loans at once. Now it's not. I know the money market is massive in the US, and the Fed will step in. They have done already to keep the commercial paper market going. So that is probably what will happen. And then it'll all blow over in the end. Tether will be gone with the wind, and so will Binance. And at last, this ecosystem that is really essential for the future of the digital economy and global welfare and the distribution of wealth in particular between the old and the young and different countries, this whole ecosystem of crypto.
She mentioned before we start, she was having some connection issues with the internet, so maybe she did have. Yes, she tried. So I think we can move to Alberto's presentation. What do you think?
I mean, she should probably be back in 30 seconds. So let's maybe give her another 30 seconds. I think she's back.
Okay.
Anyway, I think we've taken up plenty of time anyway. I'm happy to take questions by email, and I'm sorry I cut out at the end. I don't know what you got, but I was just ranting on about the ecosystem.
Okay. So thank you very much, Professor Carroll, for your time, for your lecture. It was a pleasure to hear your thoughts on this increasing importance subject. I hope we could maybe meet in the future here in Brazil, and that's our wish for the future. Thank you very much.
Thank you for inviting me.
It's a pleasure. So we can move to our second speaker. So Professor Alberto Rossi, he's kindly accepted to talk today again for our about his paper on investor behavior on cryptocurrency. Professor Alberto is from Georgetown University. So thank you very much again, Alberto. And without further ado, the floor is yours.
Thank you so much for the invitation. So let me start sharing my screen. And okay, so this is joint work. So the plan of mine, I'm going to start with maybe 5 or 10 slides on the kind of preliminary considerations, and then I'm going to be talking about this paper of mine that is titled "An Inside Look into Cryptocurrency Exchanges." And this is a joint work with Qing Chan, Wen Qiding, and Chen Lin at HKU. And let me just kind of the starting point. I mean, I wanted to kind of start broad and then go narrow, right? So, you know, like cryptocurrencies and blockchain are obviously generating a huge amount of attention, particularly blockchain. And some of it is positive, some of it is negative. Some views this market or blockchain technology in particular as like the future, and the kind of technology is going to be able to disrupt the monopoly of banks and credit card companies, for example. On the other hand, you have that possibly because of the initial the initial kind of usage of cryptocurrencies, some people instead perceive them as kind of fraudulent markets. And there's obviously a huge amount of different facets and dimensions can be analyzed. But here I'm going to be focusing on something very specific, right? So I'm going to be talking about cryptocurrencies as an asset class. I'm going to first have a set of fairly standard kind of slides on kind of how to think about cryptocurrency investing from an individual perspective. And then I'm going to show you some research of mine on individual investors trading in cryptocurrency. So what we did is we teamed up with an exchange in China, and then we actually have account level data on individuals trading. So instead of having only simple prices and trades, I actually have who places a certain trade, what kind of positions they have open, and so on and so forth. So I'm going to be able to give you a sense of how individuals trade cryptocurrencies and what are the kind of benefits and pitfalls from investing in this kind of securities. Now, the first question we should ask ourselves, I guess, is like, do we need to, like, does cryptocurrency have a place in the portfolio of an investor? Right, so here there are kind of two different views. There is a theoretical approach and there is an empirical approach to this question. I mean, from a theoretical perspective, if we go back to I guess the most important model we have in finance, the capital asset pricing model. Not that it performs great in many circumstances, but CAPM basically tells you that investors should hold risky securities according to their market weighted values. And given that cryptocurrencies are nothing else, but they really have cash currency, really like transaction value. So they are really a medium of exchange. According to a standard CAPM framework, you would actually not need to hold any cryptocurrencies, right? So you need to only hold cash for transaction needs. And given that cryptocurrencies in many cases are purely for transactions, you should hold 0 of cryptocurrencies in your investment portfolio. Now, if you were working with another standard framework to think about cryptocurrencies like the golden growth model, what the golden growth model tells you is that the price of an asset is nothing else but the discounted dividends that this asset is going to give you going forward. And this is kind of really the benchmark method for evaluating companies. And of course, given that cryptocurrencies pay no dividend, in principle, cryptocurrencies should have no intrinsic value. They should not be in the investor's portfolio. But of course, this is completely counterfactual to what we've seen in terms of the value of these cryptocurrencies and the appreciation of these cryptocurrencies over the past few years, right? So if I was going from a data perspective, one thing that I could do is to basically construct returns on cryptocurrencies, and then I could examine the empirical properties of the returns, and then I would ask myself, given securities that have a certain risk-return profile, should I use or should I have cryptocurrencies in my portfolio? And this is kind of just a couple of examples of dollar to Bitcoin exchange rate. What you'll see is that the price of Bitcoin have effectively skyrocketed in the last 5 years. Of course, we had some up and downs, but if you were getting into this market in 2016, you would have made an absolute fortune. And this is not true only for Bitcoin. Similar is for Ethereum, right? So one thing that we know is that we tend to have that prices track volume quite closely. And then for this, at least Ethereum and Bitcoin, what you're seeing is that both prices of these cryptocurrencies, notwithstanding the huge volatility, they are actually much higher now compared to 5 years ago. But however, and this, I'm going to come back to it in a second, many cryptocurrencies in the meantime have failed, right? So it's not obvious that you would have known that Ethereum and Bitcoin would have been the successful cryptocurrencies going back 5 years now. Now, of course, because cryptocurrency is a store of value, I can do the typical exercise when I can kind of evaluate a simple strategy where I'm buying, for example, Bitcoin today. Tomorrow I can sell it, and I can see how much of a return I get on a day-to-day basis, right? So if I was doing this exercise for Bitcoin and Ethereum, what you would get is that for Bitcoin, you would have that the daily return are 0.3% per day. And then I think these computations, I did them going back only to 2019 or something like this, but I think it would be pretty much the same if I was doing it more recently. But of course, this is a whopping 92% appreciation per year, right? So it's a huge number. And if I was doing the same for Ethereum, you would get even higher average percentage daily returns. Of course, however, you should not focus necessarily only on the average returns, simply because the day-to-day returns, so what happens across the distribution may be very important. And this is kind of, if I was showing you, for example, the median return on Bitcoin, they're actually well below the mean. So you actually have that the Bitcoin median return are much lower than the average, but I think it becomes even more extreme when you start thinking about Ether or Ripple, right? So in this case, you actually have that Ether has median returns that are negative. So on most days, you actually lose money on Ether, and the same is true for Ripple. So even though these assets have tremendously high average returns, they have the median returns are kind of negative. So what does this really mean? Well, it means that these cryptocurrency returns are very heavily positively skewed. And this is just an example of the daily return distribution for Ripple. If you notice, of course, they center around 0, but you see that here I have a couple of instances where on a given day, Ripple actually had a return of 160%, right? So this is, if I show you the full distribution, if I was to zoom in only on the top part over here, what you will find is that there are certain days, there are many days where you have a 100% return on a given day for Ripple. Now, one thing that what this is basically telling you is that you have to be a little bit cautious when it comes to cryptocurrency returns. So even though some of these headline cryptocurrencies may have very, very high average returns, it may be that individual investors, when they actually start trading, may not reap huge benefits from holding them in their portfolio if they time the market poorly. Now, one caveat regarding this very high return, of course, is that I was not including any sort of transaction costs. And this is like a couple of years ago, if you were actually using Coinbase to purchase Bitcoin, it would actually, if you were trying to get $10 worth of Bitcoin on Coinbase, you would get only $8.5. And then, of course, all the results I showed you so far are potentially, they suffer from a survivorship bias problem, right? So the typical example that people use here says, suppose that I have 100 coins, and I flip them 10 times. And of course, you would expect that if you flip a coin 10 times, you'll get 5 heads. But if I have 100 coins and I'm going to flip them, I'm going to have an entire distribution, right? So I'm going to have for certain coins, I'm going to flip them 10 times, and I'm going to get 8 heads or 10 heads. So what does this mean? Well, what it is simply basically telling you is that from if I was focusing only on the Bitcoin, on the coins that give return always head, I should not conclude that flipping coins always yield heads. And right, and this is kind of the problem that we have right now, is that everybody tend to focus on the top 3 cryptocurrencies, the top 5 cryptocurrencies, and they don't consider sometimes the fact that many cryptocurrencies have failed over time. And so it's actually not obvious to know whether this kind of investing in cryptocurrencies is actually quite profitable for individuals or not. And so this is kind of the main motivation behind the work that I'm going to show you right now, which once again is a very, very much work in progress. So there is absolutely a huge hype around cryptocurrencies. We always hear about the success stories of people that make a huge amount of money by trading cryptocurrencies. And at the same time, there is also huge literature showing that individuals are not particularly good at trading, right? So you have that Barber and O'Dean starting with 92 and then 96. There is a huge amount of papers showing that individuals make investment mistakes. And so in general, it's actually quite hard to know whether cryptocurrency trading is profitable or not, because you have to assume what kind of portfolios individuals are holding. This is true until you actually get data from an exchange that gives you identified trade information, right? So in principle, right now we have a lot of unanswered questions. So we don't know really who are trading cryptocurrencies, and we don't know whether it's mainly individual institutional investors, and we don't even know what kind of portfolio cryptocurrencies these individuals hold. What is their investment horizons? And we've seen this very large, wild, positive and negative cryptocurrency swings, but it's not obvious without having individual level trading information whether individuals are actually able to benefit from them, or like they're able to kind of ride the wave, or they actually get crushed. So in this paper, what we do is we answer some of these questions and additional ones. And in fact, I think I see this paper as a paper that establishes a lot of facts regarding cryptocurrency trading. And we do it using trading data from a cryptocurrency exchange in Asia, right? So, and just to give you a sense of how this cryptocurrency exchange looks like, what the exchange gives us is a bunch of investor characteristics. So we're going to have for every single trade that occurs on this exchange, we see whether it is an institutional investor, it's a market maker, is an individual investor. And of course, for individual investors, we also have kind of know your customer information, right? So we have the gender of the person, the country, the residence, the birthday, and so on and so forth. Then we also have positions. So we have the monthly positions that these individuals have. So at every point in time, I'll be able to know exactly what Alan, for example, is holding, right? So whether he's holding Bitcoin or Ether or so on and so forth. I then have every trade, and then I also have information regarding the investor's login. So I'm going to see what kind of IP address they connect from, whether they're working with a desktop or laptop, and so on and so forth. And just to give you a sense of how these look. So this is a relatively, like, it's a medium-sized exchange. So if you were going on the ranking of exchanges on Coinbase, I guess you would probably find it in the top 100, but it's not one of the very top. And so we have approximately 1 million users. But when you actually go in and zoom on how many we have customer information data, we have approximately 170,000 of them. So many people actually sign up, they don't complete the process, and they only log in to see how the prices are going. But in terms of gender distribution, we have that 60% of these people are going to be males. And the age, I think, is relatively interesting. You have that 27 years of age is the average. So you have that 30 is the median. You have some people as old as 65 that are trading, but you have a huge amount of young people that are trading here. And then this is actually going to be reflected also in the kind of portfolio values that I'm going to show you in a second. In terms of attention, you have that people are not extremely active here. So you have that they log in approximately once or twice a month. They do it through the web or through the app. But in general, like if I consider the total logins, you have 2 logins per month. And of course, some people are going to be logging in every single minute, but on average, even in the 99% of individuals are actually not as active as people would expect. In terms of portfolio characteristics, and I think this is actually going to come into place when we work with the investment performance. These are individual investors. They have very small portfolios. So the average number of assets is 2. And the majority of people have 1 asset. Of course, you have some people that have a diversified portfolio on the exchange, so 18 stocks, but this is not, absolutely not the average, the individual. So you have that the majority of people are effectively at each point in time focusing on 1 or 2 cryptocurrencies at a time. In terms of value, and goes back to the age I was talking about before, very small. So you have $274 is the average. And even at the 99th percentile, we have 781 we have $781 dollars in terms of assets. Once again, in terms of trading behavior, we actually see a lot of activity, much more activity than I would have expected. So you have that, and this is going to be something due to the fact that some individual investors actually operate as market makers, so they have this huge tail. But I think it's better to focus on the medians here. So you have the median total trades across all individuals is $27, and the average price of the security traded is $7. And I think that also what is very important here is the horizon. So the horizon here, I want to be careful about it, is how much individuals stay on the platform from the first to the last trade. And this actually turned out to be no longer than a month. So in general, what happens is that there is a lot of interest by individuals in getting on the platform and then starting to trade. But then as soon as they start trading, the majority of people actually drop off and they don't trade after a month and a half. In terms of, once again, the trade per month, you have like that is 4 and then $27. So not very large. Now let me just juxtapose this to institutional investors. Of course, there is a little bit of a concern here in trying to identify institutional and individual investors. So the individual investors may kind of sign up as individuals, even though they're institutional, and vice versa. But for some individuals or for trend traders, we know that are institutional investors. These are relatively larger in sense that they have portfolio values in the thousands of dollars. Of course, these are not large institutions, but even the 99th percentile of the institutional investors of this exchange are pretty small. I mean, they have like $1 million in assets under management, and they have that they also hold very few securities. We're talking about 2. Of course, here we're going to have that the trading behavior is going to be very different. Here we're going to have that these institutional investors are going to be placing way more trades, right? So we're talking about 190 trades for the average, for the median, but already at the average, you have 150,000 trades. So you have a lot of activity going on here. And also in terms of user horizon, so most of these institutional investors, they stay on the platform and on the exchange, and they do trades for several months, much longer than individual investors. But what I wanted to kind of convey to you is that when I look at individual investors and I look at institutional investors and I look at how many cryptocurrencies these individuals are holding, I really have to split this histogram, because I mean, the vast majority of people do not hold more than 2 or 3 cryptocurrencies. I mean, I really need to go way into the right tail of distribution. Basically, here I'm taking this histogram and I'm splitting it because there are some individual investors that have 50 tickers. They're holding 50 tickers at the same time, 50 cryptocurrencies, but the majority of people are stuck with 2 or 3. And this is the same. And this is the same also when I look at institutional investors. So you have that the majority of institutional investors have maximum 6, 7, or 8 cryptocurrencies. There is very few institutional that, whenever we look at the holdings at the end of the month, have more than 20 or 30 cryptocurrencies in their portfolios. And this is possible because they simply do not hold them, right? So they basically go in and out of the market, but they don't hold them in their portfolio. Now, if I'm looking at how much concentration these individuals have in their investment portfolio, one thing that you'll notice is that actually market maker and institutional investors tend to have more concentrated portfolios compared to individual investors. And I'm not going to spend too much time on this table, but I just wanted to highlight a little bit this second specification, where in addition to market makers and institutional investors, you have that the total trades actually is associated with a higher concentration. So portfolios that are less diversified compared to more diversified, meaning that those people that, or those institutions that trade more, actually tend to have less diversified portfolio. And the only thing instead that tends to increase the size of the portfolio is the experience. So the number of months individuals or institutions are on the platform. And in terms of the cryptocurrencies that are most traded, at least on this exchange, we have that there is a little bit of correlation with the Coinbase rank. So you see that the most traded here is going to be Ethereum, and you're going to have Bitcoin, but there are also some others that you would not expect today. And this is probably due to the fact that there are very specific local effects in terms of crypto trading. You have Ontology, for example, that is the second most traded, and instead is ranked number 28 on Coinbase. And you have Fetch AI that is 143. And so one thing that we wanted to do is to try to figure out whether the characteristics of the cryptocurrencies were related to how much they're traded by these individuals. And the answer is obviously yes, right? So you have that and we basically use just this characteristic. So the purpose of the cryptocurrencies, whether they are a currency like Litecoin or Bitcoin, or their blockchain infrastructure. The release year, whether they are ran by a non-profit, a private firm, or a community, whether they're mineable, and what is the Coinbase rank. What you'll find is that the majority, there's going to be a lot of explainability. So mineable cryptocurrencies are much more traded by individuals. The older cryptocurrencies are traded. The ones that are highly ranked are more traded. When you look at the type or the type of cryptocurrencies, whether it is for the base case for us here is the currency, cryptocurrencies, but you also have blockchain for infrastructure, computation, entertainment, financial services, and other. And it seems to be really the case that people tend to trade cryptocurrencies more than any other kind of cryptos that are related to other blockchain technologies. And then, of course, you're going to have also that community and nonprofit are also related to higher crypto. But I think that the last few things I want to talk about is the portfolio returns and the trading behavior, right? Because I think this is actually absolutely important. So this is actually tricky to do, and I'll show you the way we are doing it, and maybe you have some suggestion. We try to be as kind of standard as possible. So we can compute from the monthly position and the daily trades. I, of course, can have a view of exactly what happens on a minute by minute base or a 5 minute by minute base, right? So I cannot do everything at the tick level because it gets a little too complicated, but I can do everything at a 5 minute level, and that's actually what we do. And then we can compute portfolio returns, and then we compute returns in excess of a benchmark, right? And so if for lack of a better benchmark here, what we are doing is basically taking the 10 top traded cryptos and then construct an equally weighted skeleton. Now, what you see is that there is rather little evidence that individuals make large returns. I mean, you basically have that this is the zero. You have a lot of people that have experienced or kind of get very negative returns. But of course, there is some that experience relatively high returns. I mean, these are kind of 20% per month. Of course, this is going to be depending on how much they stay on the platform, but this is actually kind of significant. If I work with returns in excess of the benchmark, what you'll see is that once again, everything is going to be centered around zero, but you have that in some instances, some institutional or individuals actually made a killing by this, and some others instead got hammered. The simplest way to kind of estimate whether individuals are making relatively good or bad decision is to run simple CAPM regressions, right? So if these individuals were holding just the top 10 cryptocurrencies, would they do better or worse, right? So what we're doing is we're going to do it for every single individual. We're going to run this CAPM regression, and then I'm going to show you the distribution of alphas and the distribution of betas. And this is actually something that gets a little bit confusing as far as I'm concerned, because I've been working for many years with a hedge fund and mutual fund, and the typical thing you observe is that you have a beta that is very close to 1. And this is actually not what is happening here. So here you have that the beta coefficient is very small, so it's 0.5, simply because these portfolios are actually quite small. I mean, they have only 2 securities, so the market, they are actually not very, the beta on the full cross-section, the beta estimates, if I look at the distribution, is really not centered around 1. There are some that are very well approximated, but the majority are not. And when I look at the alpha, which is the outperformance, you see that I see very few people that outperform the market. So the T statistic, whenever you see a T statistic above 2 or below 2, it means that when they're above 2, that these are systematically beating the market on a risk-adjusted basis, but I don't have anybody here. On the other hand, I have that some institutions are actually doing pretty bad in terms of their underperformance. But of course, you also have that you would expect this alpha T statistic distribution to be centered around 0, and you actually don't see that much. Now, if I want to go in and look at what explains this average performance, and I can, like I have all these thousands of people, and I can see whether their alpha or their returns excess to the benchmark can be explained by their behavior some way or the other. And I can do it using total logins, the trades per month, the portfolio value, the age, and whether they're male or not. And I'm going to focus only on the alpha T statistic, which is just a measure of risk-adjusted performance. So you see is that the more people log in, so the more people actually pay attention, the more actually they tend to have a higher performance. But if I look at trade per month, it's actually negative. So the ones that actually trade more, they tend to not perform very well. Higher portfolio value is generally associated with worse performance, maybe because of market impact, maybe not, but this is what happens. And you also have that younger individuals and tend to do better, and then you also tend to have that males also underperform compared to women. I mean, we have a 36 percentage of male and female, and it seems to be that at least on the risk-adjusted basis that the males do worse than the female. And of course, if I look instead at excess return, what you find instead that there is marginally better for males. So it seems to me that potentially what is happening is that males are taking a little bit more risk than women, and on the risk-adjusted basis, they're actually doing poorly. Another side of the coin that I think is interesting to look at is the performance of individual trades, right? So there is one way is I can look at the portfolio performance, but I think there is a very large literature on individual investor trading behavior that focus instead of the quality of individual trades, right? So the idea behind this is the following. Like, suppose that I'm working with and that I'm holding in my portfolio IBM, and on a single day I decide to sell IBM and I buy Tesla. What I can do is I can compare the performance of IBM and Tesla and know whether this trading decision is actually good or bad. If you go back and look at the entire literature on individual investor behavior, starting from Terry O'Dean, what they do tell you, what they do show you is that the performance of the stocks that are sold is actually better than the stocks of the performance that are bought. So if I have IBM and I sell it for Tesla, in most often than not, what happens is that IBM performs better than Tesla. And for cryptocurrencies, actually, this is not the case. So if I look at the kind of the adjusted performance for the buys and the sells, you see that actually the buys do better than the sells. And if I look at the performance in up and down market, what you see is that for the down market, the buys are in red, in blue, and the sells are in red. So you see that in down market, the performance is definitely better for the buys and the sells, but it's also true for the up market, right? So if I compare the black line to the gold line, they also are different from each other. And so what it is actually telling you is that it seems to be the case that individuals are able to buy this kind of cryptocurrencies that do better compared to the ones that they sell. Do I find the same for institutional investors? The answer is no. So they seem to be very similar to each other. Of course, this could be a little bit of an artifact of the fact that here I have hundreds of thousands of individuals. Here I only have 100 of these institutional investors. So of course, my confidence bands are going to be larger. But basically, this is what we find. Now, just to summarize, I think that, and I don't want to spend too much time on this kind of the 10 facts that we established in this paper, but I think that what I think is important is that when you look at the way individuals trade cryptocurrencies, and what we see from this exchange is that individuals tend to hold portfolios of small value. They trade very few securities, and they have trading patterns that are very concentrated, added to the fact that they have a trading horizon that is very short. What this translates in is to the fact that these kind of individuals are not necessarily getting huge benefit in terms of realized returns, as you would expect when you look at these headlines, cryptocurrency performance like Bitcoin, Ether, and so on and so forth. Exactly because also they have a rather small investment portfolio, it is actually quite hard to benchmark the performance of these investors. But when we actually go in and look at individual trading decisions, it seems to me that the individual investors actually do not make bad trading decisions in cryptocurrencies. They tend to kind of enter the ones that the cryptocurrencies that go higher in value compared to the one they sell. So they actually seem to be at least getting this signal right. And we don't find kind of a big difference in performance between buyers and the sellers for the institutional investors, but this may also be true because we have very few of them in this data. So summary of the clinical findings. What we do in this paper, we provide novel facts regarding cryptocurrency trading. So kind of the cryptocurrency does not seem to be delivering large returns to these investors, and mainly because these investors, they hold relatively few cryptocurrencies and the horizon is rather short. And it seems to be that this is one of the few markets that I've seen where you tend to have that when you compare the performance of institutional investors and the one of individual investors, you don't have that big of a difference in performance. In fact, you actually tend to have that institutional investors don't do better than individuals. Thank you so much. I'm going to stop sharing my screen.
Well, thank you very much, Alberto, for your presentation. In fact, it's an interesting result, mainly when we compare with the behavior of individuals trading stocks. For instance, we have a huge literature on that, and we say in general, individuals are not informed compared to other investors, and they tend to lose money, and the literature is huge on that. But before I will take advantage that I'm here, and I will ask my first question. So when we compare the results, we see the individuals do not perform as bad as when trading cryptocurrency as in general individuals trading stocks, right? So at least you show this result. So that potentially could be that the investor trading cryptocurrency is in fact more informed than the average investor trading stocks.
Mm-hmm. Yeah, I mean, there is a lot of potentials, right? It may be that these markets are less efficient. I mean, one thing that is actually happens in many of these markets, actually, I mean, is the fact that you tend to have that in some cases, this kind of markets are, or these exchanges, what they tend to have is that they are all like, they're kind of single islands, but then they also have kind of arbitrageurs that basically keep the prices in line across different exchanges. So it may be that this small exchange has there is some sort of potential kind of informational advantages some individual investors can take advantage of, simply because the trade is not as large as in the top 5 cryptocurrency exchanges. I mean, if we were looking at the top 5 cryptocurrency exchanges, maybe you would not see this, but unfortunately, I don't have access to kind of identify the trades on those exchanges. But absolutely, I mean, there is definitely this concern. And then there is also, I mean, one thing that I always mention is that, there is a large literature showing that individuals back within the 90s that tended to kind of make considerable mistakes and not make great trading decisions. The truth is that back then, you tended to have that the trading fees were very large. So in many cases, most of the underperformance of individual investors, or like the bad trading decisions, were actually due to the fact that the fee was cutting in a lot of the performance, right? You basically had like fees in the order of 3 to 4% per trade. So if you look at the most recent history, you actually tend to have that there is a more and more evidence building up that some individuals are actually not trading particularly badly, right? So you actually have that they do perform relatively well. There was recently a paper by Ivo Welch on Robinhood traders during the crisis, and actually they seem to be performing relatively well compared to what you would expect if you were thinking about a barber and OD investor. But I think the truth is that it's a combination of many aspects. There is also an aspect that there tends to be always that in up market, it tends to be that individual investors tend to do rather well, simply because in many cases, individual investors tend to be momentum driven. And so if they follow momentum strategies and the market is going up, you may be kind of having a relatively good, you may record a very good performance for them. At the same time, once the market start crashing, we may see something different. But I think that broadly speaking, I think these are like fascinating questions that I think we're still struggling with.
Thank you very much. So Jefferson, I think you have a question.
Yeah, I actually got more than one. I don't know if Alberto could answer. The first one is regarding external validity. You're looking at particular exchange. It's a mid-sized, as you told us, and also in Asia. So I don't know, how can we think of larger, a generalization of your results? That's one point. The second one is regarding your benchmark. I think you created a benchmark at the KPM regressions, like the 10 most transacted cryptocurrencies. And I was thinking, why not using an index? I think Carol has an interesting paper on data, cryptocurrencies, different sources, different quality of data. And if I'm not wrong, they test, like they do some KPM regressions using the CRICS and other indexes. So I was wondering why you choose that benchmark particularly. And the third one, then I promise it will be the last one. I found it very interesting, your result regarding gender and age. Mm-hmm. If I'm not wrong, you found that the younger the individual, the larger the returns compared to older investors, right? And also that female outperformed male investors. And I don't know, do you have like some guesses or some potential mechanisms? Or maybe it's related to risk preferences, perhaps like, I don't know, females, they trade less frequently. And because of that, they earn higher returns because the frequency of the trading is negatively correlated with returns. So I don't know if you have some thoughts on that. Thank you.
That is a Barber Odin result, yes, that they trade less often. Yeah, so I guess that's really that.
Yeah, so I mean, I think, okay, first of all, like, absolutely. I mean, like external validity, this is something that, I mean, everybody always struggle with, but this is true with every single piece of work that I see on any individual investor behavior, right? And so this is actually something that I always mention And that is, I think that in many cases you have that individual investors' specific performance, in many cases, is the result of a lot of things. And this could be how the platform is designed, what kind of information is displayed to individuals. I mean, displaying information to individuals in a certain way can really lead them to be more risk-loving or more risk-averse. It's really a matter of how you actually display the information. So there is a lot of work that needs to be kind of done in terms of trying to assess whether the results are robust across different exchanges and across different reality, and what may hold in a certain exchange may be a different, maybe kind of giving a different result in another one. But I think that this is actually what kind of research is all about, right? So you basically kind of put together pieces of evidence here and there, and then as a collective, we know what is the underlying kind of overall phenomenon, right? I mean, I always said the same thing. Like, if you think about it, in many cases, we look at and we argue that many asset pricing results are true, but they hold in the US. I mean, are they something that hold everywhere else? I don't know. I mean, like, in some cases they do, in some cases they don't. I mean, in many cases you have that we're always struggling with the fact that we are dealing with one-shot realization of kind of random variables, and then we can basically analyze them. But more broadly, I think, no, in terms of benchmarking, absolutely. So the way I wanted to do it that way, I mean, to me, it was basically just saying, okay, if I was someone, and I wanted to make everything internally consistent, so I basically was using as benchmark just the prices and the trades that were coming out of the exchange, because I have the prices over there, and so I just want to construct an index there. So I was like, if I'm someone that I want to be completely uninformed and I want to do a simple thing, that the simplest thing I can do is to take the most traded kind of cryptocurrencies and then buy an equal portfolio of all of them and see what happens. So that was but of course I could use very different kind of benchmarking over there. And then I think that in terms of, I think that the channel behind which you have that females perform better than male here, I mean, I think, or also like the age, I mean, you can kind of think about an information story, like it may be that some of those younger individuals may be kind of able to kind of get information from sources in a quicker fashion, while some of these older individuals may be less tech savvy. But the truth is that without a kind of detailed information as to where they acquire information. Like, I have a paper on individual trading behavior, and what we were doing there, we actually looked at the paper is called "Does It Pay to Pay Attention?" What we were doing there is look at the browsing history of individuals on the trading platform, right? So basically what we saw is exactly what stocks do individuals see, what are the kind of pickers that they attract their attention. And then over there, then you can start making kind of get into a better understanding as to the channel that leads to the overperformance. But except for this, the only thing I can tell you is just that is what we see in the data.
All right, we have here. Okay, so we have a question from Pamela Borges. And probably the question is addressed to you, Alberto. She asking, well, I think you can access the question, right? I think it's easier to,
Yeah, I can read it out and I can paraphrase. So I think what Pamela is asking is that about some individual investors performing well, far from Odine's finding, do these results remain what we control for meme stocks like cryptos and for momentum? It seems that many perform well because they are the early buyers on some Reddit move. Does this make sense? I mean, I think that it's always very complicated to answer these questions, because in general, you tend to have that it is definitely true that when I was looking at individual trading behavior in the US, we were finding that people that paid more attention were getting higher returns. And when we actually went and looked into it, the main driver of this was momentum. So the higher individual, the people who were paying more attention to their portfolio, they were transforming themselves into momentum traders. And momentum was a very profitable trading strategies compared to not being a momentum trader in that specific case. I mean, the similar thing arises here, right? Are many kind of Robinhood investors investing in technology stocks that are being skyrocketing? The answer is probably yes, but the fact that they are jumping on this, you cannot completely discount it and saying that then they don't have performance because they jumped on the tech stocks, because exposed. This is what has turned out. I mean, they may have been lucky, but this is what we see in the data. I mean, one of the huge concern I always tell people is that whenever you work with individual investors trading, you know, when you work with hedge funds or mutual fund, even with 50 years of data, you have a trouble understanding whether this institutional investors actually have alpha or not. I mean, there is so much noise. When you're working with brokerage data that at best has a kind of a extent of 5 or like that spans maximum 5 or 6 years, it's definitely hard to kind of distinguish luck from skill. But this is kind of the limitations of the data we're working with.
Thank you. Well, I have a second question to Carol regarding the structure or the market configuration with Binance, where they act like a CCP, right? But they don't have the full benefits of having a CCP as the clearing fund, the structure of insurance that you receive. So when you don't have that, in the end of the day, you have a high risk for not being or not receive your positive P&L because one counterparty default. And I guess this is one of the main issues avoiding institutional investors to trade more in this product, because they don't want to lose money when exactly they are looking for protection, right? So you think it's this configuration was set forth by Binance as a way to launch the product, or you think they are planning to keep this model continuously?
All the unregulated exchanges use the same type of mechanism. Even FTX, which is also pretty active in Tether and has a lot of perpetual products, has a similar margin mechanism. There are two issues. First of all, Binance is unusual in that it has no jurisdiction, so and CZ completely flouts regulations. But also, they sell themselves through their education platform, which is actually excellent. So, you know, if you want to learn about cryptocurrency, you go to the Binance videos and you think, well, that's safe. A lot of the people in the class action groups, of which there are hundreds, are actually older women. That's how I got in touch with them. But I mean, that's Binance. So I suppose that places like FTX, I'm not too sure about the others, Bybit or OKEx or Huobi. Bybit tends to have smaller retail types. OKEx Huobi has larger institutions, but they seem to be more Asian. You can see that from the volume patterns. If you are going to be trading perpetuals as opposed to spot, then I would say places like FTX or, of course, CME, but they've just brought in a mini futures on the CME, so you can trade small amounts. But CME have been angling for very large institutions like Fidelity and BlackRock and so forth, Goldman's. But the fact that they're closed is a big issue. You have to trade 24/7 in crypto. It's the same thing with ETFs. You know, you want to redeem a basket of an ETF on a Saturday, and what do? Unless the terms and conditions allow T+2 or T+3 settlement on ETFs, and you get the indicative price at the time you want to redeem. So there are so many issues that need to be addressed still in crypto. Yeah. It's It's very difficult. I mean, in my journal, I get so many papers that are out of date. It's not just crypto. Because of the COVID pandemic, anything that happened, you get data that's 2018 or whatever, and is it robust? Everything's changed, as Jefferson said. So it's an issue with me because I start writing a paper and I have to be really quick. I don't care about where I publish it. I just get it out there and send it out on LinkedIn and on my website, and but by the time I finished all the analysis, I might have to just download a whole load. I usually do actually download a whole load of new data, and then it's a sort of iterative process because things change so rapidly. Anyway, I went off topic, sorry.
No, we very appreciate your words, and we are looking forward to your paper as soon as possible to read your thoughts about.
I said wait because I'm just updating a lot of stuff. So
okay.
a week or two from now,
Let's keep it.
better.
All right. Okay, so I'm not sure if we have any further questions. We are almost on time to close our session. And if we don't have, Jefferson would like to ask any further question?
There's one that Jefferson just pointed to me about data sources. Okay, so if you need to have free data, then you can go to crypto data download. Still has data from many exchanges, so it's traded data. You don't want to have VWAP indices because prices are traded on many exchanges. You might look at something like CryptoCompare, and that price is a volatility weighted average price across many exchanges, and that's fine as long as you're not thinking about anything to do with trading or whatever. If you're just looking at portfolio diversification and that sort of thing, you can get a volume weighted average price. But if you're actually looking at trading, you need an individual exchange's price. So Bitstamp still provide it free, but Coinbase don't. I wouldn't get the Binance data, I wouldn't trust it. And you can get it up to the minute level, which you need in these markets. I mean, daily is, a day is a year in crypto. So you need to have very high frequency data. When it comes to market-wide indices, the CRIX has been rectified. I've been corresponding with the people that developed that, and there are many other market-wide indices. I rather thought at the time, a couple of years ago, CCI 30 was the best, but because that only it's a square root volume weighted, so it's not so tilted towards Bitcoin or Ether. But watch this space. That's all I can say for a market-wide index. Can't say any more.
That is great. I told Professor Carol that we have potentially several students in our audience here at the Brazilian Finance Meeting. This discussion is great for those that are initiating or doing research on that. So thank you very much.
I'm very pleased to hear it.
Yes. So I'd like to thank Professor Carol and Professor Alberto for taking the time to be with us. It was a pleasure to hear. Now we are moving to a discussion of cryptocurrency related to common research topics and finances. So I think is the trend where we will have more papers understanding the trading behavior, spillover, volatility, and the area we understand more than bits and bytes. So I think that will be a trend in the future. So for those who are with us today, we will have a second panel related to digital currency. We will have later today a panel with Professor Daryl Duffy and João Manuel, the governor of the Central Bank of Brazil, talking about central bank digital currency. So this afternoon we will cover this topic, and I'd like to take the opportunity to thank Alberto and Carol, Alexander, again for the time. It was a pleasure to have you both with us, and Jefferson for handling the questions. So thank you very much. It was a pleasure.
Thank you very much. Have a wonderful day.
Yeah.
Thank you very much.
Bye-bye.
Bye.